Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. Today we want to talk about investing like a pro. Paul?
Yeah, we're going to talk about core and satellite because it's one of the methods that professional fund managers use. Essentially, we have a core portfolio that tries to give you the market performance. And as a fund manager, that's really important because no one likes to underperform the market. But then in terms of, we also have a satellite, which is a smaller part of our portfolio, which we're looking for the outperformance, Peter, the so-called alpha, that's going to make us step out from the crowd. And we can apply the same technique as a retail investor in terms of our superannuation or whatever else we're managing. Core and satellite, let's get the core sort of passively managed to deliver market performance, and we take higher risk inside the satellite. So typically the core is about 70 to 80%, the satellite 20 to 30%. The core we manage more passively, the satellite we actively manage. And so the satellite, we're really going for things that we have a high conviction about. That might be high conviction stocks like Afterpay or ZipPay or something else that's really grabbing our attention. Could be in some of the smaller caps because they tend to be a little more volatile and have greater chances of outperformance.
Like some of the miners or the biotechs?
Some of the miners. It might be in some thematics. You might be particularly bullish about the 5 to 10 year view in robotics and go for companies in that sort of industry. Or we could even look for some of the professional managers who are active managers and say, look, can you manage this for me? Because we know that you're looking for outperformance.
And like the likes of Magellan and WCM have been big performers, and they're the ones who often will help you get that satellite return. Paul, let's go and look at the portfolio of stocks that you might put together to create a core. Yeah,
so let's look at actually the three ways we can actually put a core together. And one is actually do it the hard way, Peter, but actually put it together through a portfolio of stocks yourself.
Yeah.
Now, typically a manager would probably have about 50 stocks, professional manager. But for a retail investor, that's pretty hard. It's a lot to keep track of. I would say 15, somewhere between 15 to 25 is about the ideal number. But less than 15, you really aren't getting the diversification and taking on too much risk. More than 25, it's pretty hard to sort of keep track of every company. You would look at across the major sectors. We'll come to that in a sec. Usually top 100 stocks. It doesn't have to be top 100, but they're going to be better research. There's going to be more information. You can have less sort of information asymmetry about it, so that's going to be more attractive to you. Roughly sort of sector and stock weighted, but with biases. So you might have a sector weighting towards some sectors or a bias towards some sectors. You might have a particular weighting towards some stocks. You may not, for example, say I need all the 4 banks, but you just pick 2. And you might have a more sort of a view around particular investment objectives around dividends or income rather than growth. So if you look at sort of the major sectors, Peter, you can see that really have sort of 3 standout sectors: financials, materials and healthcare. If you're putting a portfolio together, it'd be a very brave call not to have some financials, materials and healthcare in each of those portfolios.
Yeah, it's over 50% of the index.
Yeah, because if you didn't, and if by some chance you're wrong, you're really going to underperform.
Yeah, when you tweak those weightings, you can either outperform the index or underperform. So going too far away might be a risk.
And remember, for the core, we're basically looking for market performance. So we don't want too much weight or too much risk in that portfolio. Yeah, the utility sector at 1.7%, we might say, look, it really is not going to matter too much. But we use the sector weightings as a guide.
Yeah, okay, Paul, let's have a look at the alternatives to doing it yourself, namely exchange-traded funds.
Yeah, so the easiest alternative is exchange-traded funds. And of course, these are funds just to track a major index. So for example, the Vanguard Australian Shares Index ETF, it's the largest ETF. It tracks the S&P ASX 300. It invests in each of the 300 companies in their correct market weight. And you're basically guaranteed to get, however that index is going to perform, less a fraction the management fee.
Yeah,
and they do a really good job at this, and the management fees have come down. So they're down now around about 10 basis points. Vanguard with a $5.8 billion fund. So a really easy way. There are 3 other competitors to Vanguard out there.
The other alternative is the listed investment company, or LICS.
Yeah, so the broad-based listed investment companies, things like Australian Foundation, Argo Investments and Milton Corporations, they were the forerunners. They've been around for a long time, Peter. In fact, I think Argo started up in 1953. So it's been a business something like about 70 years.
And they've been helping people get the core without having to select themselves.
That's right. And so Australian Foundation Investment Company, which is largely sort of backs companies, blue chip companies, companies that have got strong dividends, expectations that they can grow and maintain, in fact, grow those dividends. They tend out to be pretty much the top 100 companies. They're, you know, Australian Foundation now $7.2 billion. It's got something like 150,000 shareholders, and it's been a really popular way for lots of so-called mum and dad investors to get basic core market exposure. These are the three big ones: Australian Foundation, Argo and Milton. Very competitive on a cost basis. Their management expense ratio is really low. And over time, they've largely delivered about index performance, Peter. Sometimes a little more recent years just a little bit under, but by and large index performance. So they're a real alternative to the exchange traded funds.
And so the logical question is, do you go for an ETF or a LIC? What's your view?
Well, let's just go back to the basic premise. An ETF will give you index performance.
Yeah.
Nothing more,
Nothing less.
All right, you cannot get more than index performance. So let's not assume they're going to get any outperformance. Okay, LICS over time have historically produced a return close to the index. Now that's not guaranteed. Outperformance has been reasonably rare, but so is chronic underperformance. So we can pretty well be confident we're going to get about index performance, maybe a little bit less. Now they've typically produced a higher dividend yield.
Yeah,
that's.
So older investors often go for LICS.
Yeah,
for that reason.
And so investors enjoy that, and franking credits make that also a positive. But it's not substantially higher than, for example, the ETF. Now the challenge with LICS or listed investment companies is they can trade at a what we call a premium or a discount to their intrinsic value, or NTA, the net tangible asset value. That means that where they're changing hands on the stock market is actually different to what the units or the shares are really worth, because their only assets are marketable securities, Peter. They could all be sold off really quickly, and they could actually give you exactly what the share price is worth. They don't have it. They don't own other big assets, intangible assets.
They own shares.
They own shares. So we can actually really accurately value what they're worth. But where they're trading on the stock market can be very different to what they're actually worth.
Because the people who are determining in the stock market can be irrational at times.
Yeah, well, not as rational as they should be.
Yes.
So we get discounts and premiums, and it tends to be they go in and out of discounts and premiums. In fact, over the long term, we've seen periods of premiums, periods of discounts.
Yeah.
So my rule of thumb, Peter, is I'd buy the LIC. I'd buy the LIC if it was trading at more than about a 2% discount. Otherwise, I'd stick with the ETF.
Because you then would expect over time to get some capital gain in addition, as the value of the fund catches up to their NTA.
Yeah, if I can buy it at a discount, and I know it's going to roughly, over time, should roughly give me index performance or close to it, over time I should actually be better than the ETF. Now, that doesn't mean it's going to happen in the next 6 months, but as a long-term strategy, that's what you'd look to do. And remember, with the core, it really is a long-term strategy.
Okay, so that's basically the guts of it, Paul. So establishing your core, what's your personal view? How would you like to get the core?
Yeah, so look, direct portfolios are hard work, and I won't say you shouldn't.
You
do
like
that.
the hard work.
I enjoy that, but I'd say for most investors, that's probably the hard thing to do.
Yeah.
An ETF for the core is really probably the logical answer.
I agree.
Of the ETFs, I probably prefer VAS for a couple of reasons. I rather track 300 companies rather than 200 companies.
You get a little bit of extra upside, can't you?
And I think also its fees are good. It's also the biggest. Then I'd go for IOZ, which tracks the S&P ASX 200. The beta shares is a little bit cheaper, Peter, but the index is not as well recognised. The other thing to bear in mind is to make that decision, I'd be keeping a really close eye on the NTAs for the LICS. Now, they publish them on their website every month. You can also adjust them intra-month according to the market performance. So it's not a hard calculation to do to work out whether they're trading at a premium or discount. If they're at a discount, then I'd think about the listed investment company.
Okay. Well, you might be asking, how do I get the satellite investments? Well, a good idea would be to keep watching this segment on nabtrade. I'm Peter Switzer, that's Switzer Investing Insights, brought to you by nabtrade.